I think it's really important first to just broadly define how we think about value investing, as there are many different definitions of it, flavors of it, approaches to it. We want to own businesses at an absolute discount to their cash flow derived intrinsic worth. In our case, we're looking for at least a 25% discount. We are not deep value, we're not traditional value. We aren't just simply seeking to own businesses at some arbitrarily cheap multiple of earnings. We're not seeking to own businesses at a relative discount to a basket of competitors or to the broader market. We're looking for that absolute discount to cash flow derived intrinsic value. We don't even like stylistically the distinction between growth versus value. Growth is very simply a characteristic. Either a business is growing or it's not. That growth can be secular, it can be cyclical. That is one of many different fundamental characteristics that ultimately you have to take into account in order to determine what is a business worth, and then what is the appropriate price to pay for that business, which brings you to value. Value is very much a judgment and in the eye of the beholder. In fact, if you take a couple of different examples, to take a business that trades at 15 times earnings, it's worth 20 times earnings. That in our eyes oftentimes represents a more attractive value than say buying a more statistically cheap business at 9 times earnings that's worth 12. That business at 15 times earnings is likely higher quality. It likely has a more defensible margin structure. It can grow. And so what that means is that ultimately we're looking for two sources of return. We want that multiple re-rating from 15 to 20 times earnings, from 9 to 12 times earnings, like most traditional or any approach to value investing. But we're also looking for a secondary source of return, that being the compounding of the business value over time, whether that be through earnings growth, free cash flow growth, good capital allocation by a management team. And so that gives you a sense of how we think about and define value investing. We're very long-term investors. Our typical investment horizon is 3, 5+ years, ideally. The best case is if we never have to sell a business, so long as that underlying value continues to compound over time. We think of ourselves as owners of businesses. We don't view stocks simply as pieces of paper to be traded. We have an ownership mentality over the businesses that we are owning. Finally, from a risk standpoint, the way that we think about and approach risk management is also in an absolute sense. And what I mean by that is that we are simply seeking to avoid permanent capital impairment. We don't view risk through any sort of quantitative lens. We're not thinking about tracking error or standard deviation. We don't think about overweight, underweight, the benchmark, certain sectors, industries, regions, or countries. But instead, we are trying to avoid a couple of common risks that value investors are faced with through trying to buy businesses cheaply or at a discount. The first of those you can think of as your classic value trap, where there's a business that looks cheap, it is statistically cheap, but there might be a good reason for that. That business might be in structural decline, where it looks cheap on a backwards-looking historical basis. But if those earnings are in decline or the business is in decline, then that is not going to end up being an attractive valuation as time passes on. So to help mitigate that risk of a value trap, we place a heavy emphasis on business quality. And then secondly, and similarly, those same statistically or optically cheap stocks can have high degrees of leverage on the balance sheet. Leverage can certainly be a good thing when there are economic tailwinds behind a business. Value can obviously accrue very quickly to shareholders. It's also one of the quickest ways you can permanently impair capital. And we prefer risk-return scenarios that are asymmetric, and so therefore place a heavy emphasis on financial strength, balance sheet strength. Taking everything that I just said there from a very high-level philosophical standpoint, our time horizon, how we define value, how we approach risk, and if you distill it down to 4 key characteristics that we're looking for, first and foremost is that undervaluation component, that 25% discount to cash flow derived intrinsic value. The next 3 are more risk management oriented. There are insurance policies. Again, we want to own high quality businesses that have dominant market shares, strong competitive positions, healthy free cash flow generation, defensible margin structures. As Warren Buffett likes to say, there's a moat around the business. Third, again, is that financial strength component. We love net cash on the balance sheet, but at the very least, we want the balance sheet to be a resource rather than a restraint. What brings me to my last point is in the hands of a great management team. A management team who thinks like we do, who think like long-term owners of a business, who are appropriately incentivized and compensated, who have good track records of capital allocation by making accretive acquisitions, reinvesting in the business, or in the absence of those opportunities, they're returning capital to us, shareholders, through dividends and buybacks. And so that is what we are seeking to do, day in and day out, is combine a portfolio typically of between 35 to 40 businesses from around the globe that have those characteristics in different shades of gray.